Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome back to the show, Tim.
Jim, and thank you as always for having me.
Tim, people are wondering, have the equity markets in the U.S. peaked, or do they have more room, and what's kind of a historical view on this, a master picture, if you will?
Yeah, I would like to lay that out. You know, we did it a few weeks ago for another audience, and let's walk through it again here. You know, I've been talking about, you know, the bubble, and it truly is the largest bubble in stock market history. But let's back up just a little bit, and let me give some data on that to support it. You know, I have, you know, long-term economic data going back to 1800, and it clearly shows that we began the sixth economic cycle since 1800, coming out of the 2001-2002 low. When I say 2001-2002, commodities bottom basically in 01, and of course equities in 02. Well, going back to the top in 2000 in equities, I have said that was the organic top in equities and the economy, I believe. And I can support that. If you go back to just some basics, I mean, if you look at equities, it's real simple. You see the volume characteristics of the market have, you know, they changed, and you can pick up any basic technical analysis book and you see, you know, going into the 2000 top, volume rose as we moved higher and it declined as we moved lower. And then from 2000, it's the mirror image. You know, you have advancing volume on the declines and you have declining volume on the advances. And, you know, people have tried to rationalize, well, why volume is declining and all, and that's not my point. That's not what I'm saying. Listen to what I'm saying. The characteristics changed. And that you can't, there's no rational there's no explanation for, other than it's, you know, it's a different environment. And in addition to the volume characteristics change in 2000, we saw, when I say it's the organic top in the economy, if you look at, for example, the labor job participation rate, labor force data, it peaked in early 2000. No question about it. If you look at the velocity of money going into, the velocity of M2 going into that organic top in 2000, it peaked in July of 97. So you have these underlying factors telling you, I mean, basic underlying, you know, indicators telling you that we had, like I said, an organic top. And then we roll over, moving back forward, out of at that time, the fifth economic cycle bottomed. And then we began this sixth cycle. Well, this sixth cycle coming out of the 01-02 low has been based on monetary policy. I mean, I think that's a foregone conclusion. I mean, look at what has happened. You know, we started seeing this coming out of those lows, and it led to, you know, those policies led to trying to re-stimulate the economy and grow the economy and bridge the gap, as they said. It created the biggest bubble, or let me say this, at the time, it was, I don't want to use that word, it created the worst financial crisis since the Great Depression, leading into the top in 2007. That it created the housing bubble, it created the commodity bubble, and so forth. But it was all based on, again, monetary policy. if you look at the underlying, like the velocity of money, it ticked up. It responded. It ticked up coming out of a low in 03. And then we saw, a little bit of an uptick in the job participation data during that time. But it wasn't much. I mean, it's a blip, right? It's a counter trend move in the bigger picture. And then all that turns down. We roll over into the decline in 2008, 2009. I say 8 because some commodities bottomed in 8, equities in March of 9. And then from there, we see more of the same practices that got us there in the first place. Well, this time you look at the data and you look at the velocity of money and you saw an even less response. And you look at the labor data and it's even weaker. You look at the commodities, oil peaked in 2008. You look at gold, it peaked in 2011. This time we haven't seen that reinflation back in the commodities market. We've seen it pretty much in the equities market. That's, the big bubble. And now, long story short, here we sit. And at the top of, in my opinion, and I think it's pretty easy to prove, the biggest equity bubble in history. And people can't even see it because, it's gone on so long and it's become like a new norm to them, so they don't realize the environment we're in. Well, at the same time, we're seeing this sixth economic cycle, according to, the data that I have. I mean, I say according to, it's clear to see that it's rolling. It's begun to roll. And these are, a massive top, it's kind of like the saying, turning a battleship. And so we're in the setup. It's happening. And, with equities, of course, we declined into the low in December of last year. And now we've seen this advance. And I think that we are in the process let me say this another way. We are at a, extremely important, technical juncture in which I think literally this market has to inflate or die. And, I think the battle is on. I think that, everything is being done from, news manipulation to you name it to try to reinflate and keep things together. And maybe it works. Maybe it can. The jury's out. That's what I said. We're at that juncture. And, if it does, then okay, it lingers a while, until we get structure and, some things that tell us that it's over. If it doesn't, and we start to see signals and structure and stuff to tell us that it's failing, then I don't think it's a 2001 and 2002 or even a 2007 and 8 period. I think it's a much, much, much bigger problem. It's the bursting of the largest bubble in history, and it's a global bubble. And I think the purging of the enormous debt that has been built in this bubble, it is a massive, massive problem that has to be, I guess purged is the right word. And we're in a technical window, I think throughout the next few months where, it could potentially take hold. So that's kind of the background and where we're at.
Now, some of the people I've talked to still expect the equity markets to continue higher. I guess the question is, for how long and how much higher?
Well, people, I don't know how to explain this. And if people have an understanding of the markets, then they will understand this. But you have signals and a system that guides you. But within that system, I have this big picture work that tells me where I'm at. In other words, you're driving down the road, but I know I'm in the state of whatever, California. The shorter term, of course, with the cycles work guides you within the big picture where you're at. I mean, big picture, again, we're at the top. Short term, intermediate term, yes, we have this advance out of the December low. And, I think we're probably at an intermediate degree top, and we're going to roll over into an intermediate degree low that is due in my work in June, ideally. Cycles are somewhat fluid. You can't just put them in a box, but ideally there's some lows due ahead of us. I think we roll over into those, and then, one step at a time. And then, if we see the signals start to occur and indications that this advance is over, then it also opens the window for, more trouble. Looking at the big picture, I think it's a matter of time. I really think that this thing is setting up for a massive, massive top. But short and intermediate term, yeah, maybe we're not there quite yet.
We'll have more with Tim Wood right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Welcome back. We're speaking with Tim Wood. Tim, what do you expect is going to happen with commodities with a bubblish equity market?
Lower. Commodities did not respond. Commodities have not responded in conjunction with this last round of, when I say this last round, coming out of the 2008-9 lows. They simply, it's a matter of looking at a chart. You can see it. They have not responded along with equities, and I think that's a telltale sign. There's some historical precedence to that. There's some cyclical relationships with that I have laid out in the last letter. It's stunning when you look at the data. But I think that is a sign, and I think interest rates are a sign. And another piece of it, of course, is the strength of the dollar. We talked about that last year and how the dollar was going to be strengthening, and it has. Another sign of, I think, the deflation, or at least the deflation that is trying to take hold, is we're seeing it with gold. I mean, no one wants to admit it. I consider myself a gold bug too, but I also consider myself a realist, and then I look at what I look at, and many of the industrial metals, I'm not looking at them now, but I keep an eye on them, ever so often. Many of them have broken down below their most recent lows, and I don't remember. I was looking at lead and tin and nickel and all of them. And I don't remember, but some of them have broken, some of them haven't. But the point is that the cyclical rhythm is all the same with gold, and those are indications of the deflationary pressures. And it's like it's like a tug of war. We have this battle that is going on, and it's like, okay, the bull, he pulls the bear a little bit, the bear pulls, it's back and forth, and all the while, what is happening is you have a setup that is technically falling in place, and a domino falls one by one, and it's taking so long because it's such a big top, and it's been what word do I want to use? Manipulated. I mean, and that's not an excuse. It's a fact. I mean, it's being tried to be, who wants it to fall? And they're trying to hold it, of course, but it is like trying to hold back, stick your finger in the cracks of the dam. I mean, at some point, you just can't do it anymore. and finally the forces give way, and that's kind of the scenario that we're in. And we're in a juncture, like I said, we're seeing signs of the deflationary forces taking hold, and then when we get a little bit further ahead with equities and see the right dominoes fall there, then it could be a floodgate. Absolutely.
Is the U.S. equity market being kept afloat and expanding because of all of this money fleeing from Europe, where they have negative interest rates?
That could be. I don't know. That could be part of it. The one thing that we do know, or that I can say, is that Europe led. Like, for example, if you look at the Stocks 600, which is a broad-based European index, equity-based index. It led at the top in 2018, and the emerging markets led. So there's a number of leading indexes and indicators. So maybe some of that money has found its way into the U.S. markets, which is why the U.S. market lagged with the setup last year into the October top. And we're probably seeing some of the same thing now. But like I said, it's just, it makes the process grueling, and it's taken so long. I mean, few people believe or understand what's going on. But I'm telling you, this is serious. And the unwinding will happen. It's going to happen. I mean, the data is clear. It's a matter of how well it can be contained, delayed, and, postponed.
We'll have more with Tim Cyclesman Wood right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, if the equity markets crash, will the U.S. dollar increase in strength because it's seen as a safe haven?
I think let me answer that this way, and it's not a cop-out. We talked about this way back last year in February. We had that long-term cycle bottom in the dollar. And my answer is the dollar is going to continue to strengthen until I see evidence that that cycle has peaked. And at this point, I see no evidence. I mean, any weakness in the dollar, I think, is counter-trend at this point. I think the rising dollar and the deflationary, the trend is the rising dollar as the deflationary forces continue to try to take hold. And we're seeing those deflationary forces trying to take hold with commodities. I think that the advance we've seen in crude oil, yes, it's been nice, coming out of the December low, but it's the same sort of things going on in equities, the same pattern, same cyclical advance. I think in the case of crude oil, it is definitely counter trend. In the case of equities, we're finishing up a setup. How much longer that's going to take, I'm not quite sure. But I will say this, and this is going to blow some people's minds. Some people may disagree with me. I don't care. I can prove it. I know what I'm talking about. The advance, let me say this another way. The decline last year into the December low triggered a Dow theory primary bearish trend change. There are some who think that has been reversed. It absolutely, positively has not been. That's still in force. And I think that is a warning of what's going on in spite of the duration of the rally. That's kind of a complex situation or explanation to explain that. But I'm 100% confident of it. The information's in my May letter as well as, the information about this sixth economic cycle. And so these are warnings. I realize this has taken a long time to set up. That I can't help, but it doesn't change what it is. And so, no, I think we are definitely dealing, I stick to that, with a massive, massive top in the making. For now, we can't quite say that this advance out of the December low is over.
What is this going to do to the price of crude?
Down. I think all commodities are going lower.
Do you think people expect that to happen if there's, again, a lot of people have suggested that the correction after Christmas was enough to keep this equity giant rumbling along, was it?
I don't, not in my opinion, no. And let me give you something on crude. I have, that's one thing, again, I don't mean to sound like a salesman, but it is what it is. I have posted charts in my updates and in the letter showing people, when I say that I think crude oil or is peaking, if it hasn't already peaked and it is counter trend, is that I have data that you can overlay. Okay, well, here's this economic information, economic data, and here's the correlation. And when this happens, and here it is going back in time for history. And so I have seen the data that suggests that crude oil is that it's a counter trend advance. And if I see something that happens 99 times out of 100 or 9 times out of 10 or whatever the case may be, the high percentage of time, and I see it occur again, then I'm an idiot to not expect the same thing to happen this time. Although there may be a slim chance, but you should expect the same result. And so the data tells me that no, counter trend. And I realize how hard it is for someone to believe something that they can't see. But I can't help that. If you want to see it, the research is available.
Tim, is there anything you want to sum things up with?
No, other than that, I think it may be the calm before the storm the next little while. How do I say this? Trying to find a better way to say it maybe. I said that it was we're at an important technical juncture, but, it's, maybe that is the best way to say it, but it's the opportunity, the risk, I think is going to be increasingly higher as we move through the next few months. And then, like I said, we'll see how the inflate or die scenario sets up with this, as we move through this important technical juncture, and then, reassess. But, I do think that the opportunity, for the equities to turn down here is pretty high as we move, like I said, through the summer.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.